Do you want to diversify your portfolio and avoid all of those capital gain taxes? Well, I want to provide you with one particular asset to include, but you gotta put it in the right account. And if you want to find out more about which asset to include and which account to put it in, then stay tuned. Hello, I am Dr. Brittany Helford, and on this channel, I teach you how to have more joy and more wealth with your money. Now, I mentioned an asset that I want you to include in a particular account, and that asset is a REIT, or a real estate investment trust, and the account is a Roth IRA. Now, if you don't know anything about Roth IRAs, then I want you to go to this video right here where I talk about the differences between a Roth IRA and a 401k. And I want you to go to this video right here where I talk about a backdoor Roth IRA, because depending on your adjusted gross income, you may have to choose a different pathway to get access to the Roth IRA. And I want you to make sure that you know all of the details before taking action. Now, let's get back to real estate investment trust, because when I was a resident physician, I didn't know anything about these things. I knew that there were many people in the world who invested in real estate and they saved a lot of money on taxes, and they also increased their passive income. But unfortunately, I didn't have thousands of dollars to put on down payments, to purchase land, to purchase homes, to do flips and all of that jazz until I learned about how to invest in real estate in a very passive way, but still get some of the benefits of real estate. And that is through real estate investment trusts. REITs are companies that own, operate, or finance income-producing real estate properties across many different industries like commercial, industrial, residential. Putting real estate investment trusts into your Roth IRA gives you all of the tax advantages of the tax-free growth and tax deferrals without having to worry about how much you're going to have to pay in capital gains tax. Because real estate investment trusts are required to pay out 90% of their dividends to their share owners. And if you imagine that every single quarter, depending on how many shares of that real estate investment trust you have, you're getting a significant amount of income. Now, income is never a bad thing, but if you're a high earning medical professional like me, we know that all of our income is going to be taxed at that higher rate. Now, capital gains tax is a little bit different, right? But you still want to ensure that you have protections against all types of taxes when it comes to your income. So using a Roth IRA to hold this asset allows you to get all of the value, the market appreciation that happens in real estate without the tax liability. Now, a Roth IRA uses after-tax dollars, meaning that you've already paid taxes on that money and it has arrived and hit in your bank account. So you're now going to use this money to invest in a Roth IRA, either the direct way or indirect, using the back door. Then you will take the next step to choose a real estate investment trust. Now, there are many types of real estate investment trusts. There are equity real estate investment trusts, mortgage real estate investment trusts, and hybrid real estate investment trusts that have various different risk profiles, dividend payouts, and tax efficiencies in efficient manner. So you want to make sure that you understand exactly what type of real estate investment trust you are investing in. Now, we know that not everyone has the money or the time to own and manage a property, but this is a way that you can still invest in real estate and have the diversification and the growth that the real estate market provides without all of the risk of owning and holding managing a property. Now, because REITs pay out dividends, 90% of the income in dividends, you will have that compounding effect of all of those additional dividends that you can invest in something else, to buy more shares of the real estate investment trust or to buy other types of stocks and assets within your Roth IRA. Then when you pull that money out at the time of withdrawal, you will have that compounding growth without paying any taxes at the time of withdrawal. This is a way that you can shield yourself from this tax burden that investing in this tax inefficient asset provides while reaping all of the benefits of investing in real estate. Now, of course, with any investment, there are potential risks. And just like investing in real estate, if you only have a REIT that invests in a specific type of real estate property, say for example resort hotels, or are only located in a specific area of downtown Chicago, let's say for example, and there's a huge shift for people to move to the suburbs, then that particular real estate investment trust may be subject to that environmental pressure of everyone moving. Or if people are unable to go on vacations and now you've invested in this real estate trust that only has resort hotels, then you may be losing money. But anytime you're investing, you need to understand your risk profile, which is so important for any investment. And remember that investing in real estate investment trust is just one of the ways that you are diversifying your investing profile, that you're not going to put all of the money in your Roth IRA in REITs, right? Ideally, you will have some mix of various assets that allow you to protect a portion of your income against some of these environmental pressures. Now, if you thought that this was helpful, then I want you to subscribe to this channel and share this with a friend, because for me, as a new woman in healthcare and still learning about money, I was really unaware of how to utilize this asset in the most tax efficient way. And remember, it's not about the money you make, it's about the money you keep. And on this channel, I'm going to teach you how to keep more of your money, how to use your money for joy, and to grow your wealth. So I will see you on the next one. Bye-bye.